Welcome to 16 Ways to Reduce Your Taxes When Selling a Business. My name is Loic Lemenner, founder of Opus Wealth Management. We're going to cover a lot in this video, so you can skip to the chapters you're interested in by clicking on Show More in the description down below. Furthermore, you can click on the little gear icon below to view this video at 2x speed. Lastly, in the chapter titled A Quick Summary of All the Strategies, I'll cover a very short intro to all the strategies so you can decide which ones you might be interested in. But first, please heed this warning. My warning is this: I'm not a C.P.A. I gloss over about 1,000 details during this presentation, so do not take something you hear in this video and go implement it. The purpose of this video is merely to give you an introduction to something that might work for you so you can bring it up to your advisory team. Why are taxes such a big deal, and where am I getting this unheard of 87% tax rate? Well, these are numbers that we ran for an actual client who wanted to sell a slice of his equity to his management team. And so for today's purposes, we'll assume that slice of equity that he wanted to sell was $4.5 million. And the tool they were going to use was going to be an installment sale. Now, this team is a very cohesive management team. They really care about each other. So they wanted to make the entire transaction as efficient as possible. So we modeled it from both the buyer and the seller's perspective. And so here are the columns for the seller. You can see the net proceeds and the taxes that he'll have to pay. We also modeled the net cost to the buyer, but we also modeled the taxes it was going to take for the buyers to have the after-tax dollars to pay the seller, right? When you buy a company, you have to pay for it with after-tax dollars. So when you model the buyer and seller's taxes, these are the numbers that we came up with. And on a $4.5 million transaction, it ended up that the total taxes that were going to go to the IRS were $3.9 million, which is an 87% tax rate. And that's in Texas, where we don't have a state income tax. So you can imagine in states like California, you'd be pushing above 90% tax rate. And that's incredibly oppressive. So the rest of this presentation is going to be, well, how can we lighten this burden? As promised, we're going to go through a super quick intro of all the strategies. So I broke the strategies down between pre-sale, transaction type strategies, and then post-sale. So the first strategy is C to S-Corp Switch to avoid the double taxation of a C-Corp, moving the geography of either the owner or the business to a more friendly tax environment. Number 3 is to move equity out of your estate. 4 is to gift to an older generation. That has to do with taking advantage of a step-up in basis. Number 5 is how Section 1202 works and qualified small business stock, how you might take advantage of it. Number 6 is either ahead of the transaction or as the transaction itself, using an employee stock ownership plan. Number 7 is using a phantom stock plan to compensate your employees ahead of the transaction to get you there. Number 8 is gifting charity. This has to be done before the transaction, but oftentimes it can be done around the time of the transaction. Number 9 is using an installment sale as a tool. 10 is rolling over your equity so that rollover equity doesn't get taxed. Number 11 is dying with the business. So maybe installing management so that you don't have any taxes to pay during your lifetime. 12 is the transaction tax allocation. So there are many buckets of treatment that different assets will get at the time of the transaction. We'll talk a little bit about that. Number 13 is a stock versus asset sale. Number 14 is what I call the family office entity. This is the ability to set up a business entity to help you deduct some meaningful taxes. Lastly is using contract income instead of an earnout. That can be very interesting. And then one very flexible strategy that spans this entire spectrum, because you can use it. You can use it to start a business in, and then you can use it at the time of the transaction, and even after the transaction are opportunity zones. C to S-Corp Switch. The primary motivation here is that buyers typically don't want to buy your C-Corp shares due to the liability that they'll inherit and the less favorable tax implications for them. If you sell assets of your C-Corp, you'll get double taxed. So one solution is to convert to an S-Corp 5 years before the year you might sell the business to avoid the double taxation problem. Now, you might really enjoy being a C-Corp because you're getting a 21% tax rate and you're reinvesting a lot in the business. If that's the case, you may want to look at our stock versus asset sale later in this presentation. Lastly, you may want to ask your accountant about switching to an S-Corp even if you plan on selling the company before 5 years, because you may not have the gains built up to make this unattractive. The next strategy is to think about the geography of the business and the owner. Maybe you can move the business to a low or no income tax state. Sometimes you can negotiate tax credits with the municipalities that you're moving to. Especially if you're a service business and have a lot of work from home employees, it may be very easy to move the business. Short of moving the business, maybe the owner can move. Most owners use flow through entities where their business profits hit their personal tax return. And that way you could avoid state income tax, especially if you're considering a sale, having a lifetime of value avoid state income tax may be well worth it. The last US centric idea is to use a special kind of trust. You can have a trust where the situs of the trust, the location of the trust, is a no income tax state. These are tricky and pretty advanced kind of trusts, so definitely get an attorney that's used to drafting these. But depending on the state that you're coming from, it may be a possibility for you. Next, if you're willing to go abroad, Puerto Rico has Act 20 and 22 that allows you to get 100% exemption on certain types of taxes after jumping through certain hurdles like residency. And then lastly, the US Virgin Islands has an economic development program. They give you 90% deductions on certain corporate and personal income tax and other economic benefits. For both of these programs, you have to navigate residency tests and other requirements. But if you're open to living in either location, it could be a home run. The next idea is to think about where your business value is growing, inside or outside your state. Here are actual numbers that we ran for a client. He had just bought a nice $3 million EBITDA business and thought he could grow it very conservatively at 5% net of inflation. So I asked some investment banker friends of mine what kind of multiple a business this size in that industry would go for, and they said it would sell for about 4 times EBITDA, which netted my client a $12 million business value. So currently, estate tax credits, how much you can leave your kids tax free, are a little over $12 million per person. So he'd be fine at this point. But if he grows his business in his estate, look at what happens. At a 7.5% growth rate, he more than doubles his EBITDA in 10 years. The investment bankers told me that at that size, the business would be worth a 6 multiple. So his business is now worth $37 million. Add to that the fact that current law states that estate tax credits fall to something like $6 million per person in 2026. It's inflation adjusted, so we don't know the exact number. So in 10 short years, if he grows the business like he thinks he can, he'll have created a $9 million tax for himself. In 20 years, with the power of compounding and a couple more turns on his multiple, his estate tax would grow to a huge $35 million. So what's the alternative? Well, let's take an example of a business owner who's got a $45 million business, but they're willing to be proactive and move some of that value out of their estate. So one thing to know is when you move shares of a closely held business to a trust or a child, the IRS lets you take a discount for lack of marketability, lack of control. So in our example here, let's assume that that discount is 30%. So the $45 million becomes $32 million in the IRS's eyes. And then if you're sure that you're going to sell to a third party at some point, you wouldn't have to worry about the value that is going to go to the IRS when you sell the business. So for today's math, let's call that 25%. So 75% of the 32 million becomes 24 million. That $24 million is actually under today's estate tax credit. It's under the $24,120,000. So you could transfer that entire long-term family business value out of your estate and let it grow so that it can turn into 48 million and an unlimited number without ever being subject to estate taxes. Now, one thing I always hear when I talk to clients about this is, Loic, I need this value to live off of, right? It's gonna finance my retirement. And so one important caveat is that if you give it enough time, you absolutely can set up a structure where this value is out of your estate, and as a married couple, you have access to it for the rest of your joint lives. Next up is gifting to an older generation. So this strategy can be wonderful for the right family. What we're doing here is using the rules around step up in basis to eliminate potentially decades of built in gains. So we have a couple, and they're business owners, and you could do this with any appreciated asset, but we're going to assume some real estate tied to the business. Sally, the wife in the couple, has an elderly mom that she's on very good terms with. What they can do is gift this real estate to mom. Now, mom has that piece of real estate in her estate and she gets the cash flows from it. So she can either spend it if Sally had been planning to help her mom out financially, or mom can just let it accumulate in an investment account. And then what happens is when mom passes away, the property reverts back to Sally, but Sally and her husband get a step up in basis. So the cost basis of the property becomes what it was on the date of mom's passing. So obviously, you have to have a parent that can be trusted. You have to have the right family dynamics, but this can really be very powerful in wiping away decades of accumulated gains. There are a couple hurdles with this to keep in mind. One is the IRS has a 12-month look back rule, so you can't do this on somebody's deathbed that you expect to pass away over the next few months. And then the other hurdle is that your parents may have a taxable estate themselves, so you don't want to increase their estate tax by gifting them assets during their life. However, as we just saw in the previous idea, the estate tax credit today is $24 million, dollars, so that doesn't affect too many people. But if you have the right family dynamics, this could be a really amazing strategy. Our next strategy is Section 1202. You might have heard it called qualified small business stock. So this is a section of the IRS code that Congress had created to incentivize innovation. So, what do you need to do to be eligible? Well, you can't be basically in services. What this really works out well for are companies in manufacturing, construction, and technology. And so, big picture, how does this work? Well, you got to be a domestic C Corp. To get the tax break, you have to own the entity for at least 5 years. There is a cap per investment, and so you get to exclude from your gains the greater of $10 million per taxpayer, or 10 times the adjusted upfront basis. I'm not going to go through the adjustment rules; they're very complicated. But more or less, if you had a cost basis of $2 million, you could exclude 20 million. The gross assets of the C Corp have to be under $50 million. So this is meant to be for small and medium sized firms. And then one thing to note, which we'll look at on the next page, is you can possibly multiply the exemption by using a trust structure. Let's run through an example of how qualified small business stock might work for a company. So if you had a firm that wasn't eligible for qualified small business stock, if you sold it for $40 million dollars and the cost basis was zero, you have $40 million dollars of taxable gain at a 23.8% tax bracket, which is optimistic. You'd owe $9.5 million dollars. That's far from optimal. If you had a firm that was eligible for QSBS, the gain is the same, but now you get a $10 million exemption. So the taxable gain is only $30 million. Assume the same tax rate, and you already have decreased your taxes by about $2.4 million. Now, what if you could spread the ownership of the company amongst various entities to create four owners? You could do this with irrevocable trust. You could do this with family members. And so the sale price is the same, but you multiply the $10 million exemption times four, and you owe zero taxes, or you save yourself $9.5 million. Now, there is the code section for QSBS did not specifically address irrevocable trusts, but Bob Keebler, who's the tax attorney that does a lot of the AICPA's training, I think his exact verbiage was, "It's very likely to work." So you have to ask your own attorneys and accountants what they're comfortable with, but I've seen a lot of attorneys' accountants very comfortable with that interpretation. The next strategy we're going to look at is an employee stock ownership plan. So the way these plans work is you're selling your company to a qualified retirement plan, much like a 401k. So what you're doing is you're manufacturing a buyer out of thin air. Thus, the natural next question is, well, where does this plan get the cash to buy me out? Well, it can come up from one of two places. It can come from the underlying cash flows of the company, or it can come in the form of a bank loan that the plan takes out to pay the owner out more quickly. Now, the thing about ESOPs is that they're incredibly flexible. The owner can sell a portion of the business or their entire business to the ESOP. They can keep control of the business. They can spread the sale of the shares over many years. You can keep some of the shares even after retirement. You could still sell the company to a third party in the future if that is the company's desire. And relative to M&A, it has low transaction costs. Let's dig a little deeper because ESOPs can be quite complicated. So, as we just got done saying, ESOPs can be really flexible. I had an ESOP attorney tell me they're the Swiss Army knives of exit planning because there's so many ways to design them. They can greatly reduce taxes. ESOPs by design are a qualified retirement plan, so the ESOP does not pay taxes. Uh, it will increase your employees' ownership in the company. So done well, it can materially improve the culture of the firm. It also increases the company's cash flows because whatever cash flows go through this ESOP aren't taxed, and it allows the owner to diversify perhaps earlier than otherwise if they were eyeing a third party sale but wanted to take some chips off the table before a third party sale. So the cons: ESOPs can be expensive to set up. I mean, you're almost always going to save significantly more money in taxes, but an ESOP plan can cost upwards of six figures to set up. There is year-to-year administration. You don't want to run afoul of any government rules, so you have to go in with your eyes open, realizing that there's going to be annual work to do on the ESOP. And then the flexibility of an ESOP, ironically, can create decision fatigue up front. There's so many ways to design ESOPs. Going through with your team all the different permutations can sometimes be burdensome. So you might consider ESOPs if you want to diversify but keep control of the company, take some chips off the table, and you don't want to consider a private equity recap. If you're not a maximizer, if you're not trying to get top dollar for your company, you're prioritizing things like culture and continuity ahead of getting the most you could possibly get for your company, and ESOP might be right for you. And then you're looking for ways to significantly reduce taxes because so much of the ESOP's power is in the ESOP plan itself being that qualified retirement plan. Next, we're going to talk about phantom equity plans. So many of you are familiar with phantom equity plans. You might be wondering why I'm including them in a video about reducing taxes for business owners upon their exit. And the answer is because of the way they're taxed. So oversimplified, a phantom equity plan is simply a promise to pay a cash bonus when a triggering event is reached. So it's meant to feel like equity because a lot of times it's tied to growth objectives of the firm. But the phantom part about it is that it gets paid out in cash. So let's look at how a phantom equity plan is taxed relative to a restricted stock plan. So if you have a restricted stock plan and you give $1 million worth of grants, that is considered compensation to the employee. And as the business owner, you get a $1 million deduction. Here, we're assuming that in year 6, those same shares are worth $4 million. But as the business owner, you already gave them away. So you get a big fat bagel for a deduction. With a phantom equity plan, the nicer features of that plan are that it doesn't cost you anything up front, right? All it costs you is the attorney fees to draft the agreement. But since it's a promise to pay upon a triggering event, I'm assuming here that the triggering event is a sale of the business, you've got nothing to pay to the employees. So while you're ramping up for your sale, you've got all your cash flows. And then in year 6, assuming a sale happens, now you owe your team $4 million. But in the year where you're the most flush, in a year where you have probably the biggest tax burden of your life, you get this nice $4 million deduction, which is considerably more than what it was under the restricted stock plan. So planning ahead and aligning your compensation with your exit is really critical to being as efficient as you can be with your taxes. Next up, charitable gifts. Now, a lot of people know that you can get a bunch of tax goodies for giving to charity. What a lot of people don't realize is the difference it makes gifting to charity before the sale of your business versus after. So before we go into the math, let's talk about different ways to gift to charity. So you can gift to charity expecting nothing in return, which of course maximizes your deductions. But you could also gift to charity in a structure where you get an income stream back from those shares. in case you're worried about your income during retirement. And then a third way to gift is to gift to charity, create an income stream back to you, but that doesn't start paying right away. That builds up in case you have an earnout, you're not going to retire for 3 years. That's a possibility as well. So just know that you have different design variables when you're gifting to charity to mold your charitable gift for your family's needs. Now, in general, when you are giving shares of a closely held business to charity, the IRS says you can't have a buyer in waiting to have the pre-sale tax treatment that we're about to discuss. So, if you have a letter of intent signed, a lot of times I hear that is a threshold. You're not going to be able to get the pre-sale tax treatment. You also have limits on the AGI and how much you can deduct relative to your AGI. So if you make a big charitable gift and you don't sell your business in that tax year, you may not be able to exhaust your entire deduction. So what you do in that case is you can roll the deduction forward for 5 years. So if you sell your business the following year, you can then exhaust your entire deduction. Or if you end up not selling your business and you just have cumulatively enough income, enough AGI to exhaust the entire charitable deduction, that works out as well. Okay, so now let's talk about the math of this. So here I'm assuming somebody wants to give $1 million value to a charity, very generous. They have a zero cost basis in their business. And in this first example, they're going to sell their business. They're going to pay taxes. I'm assuming 23.8. That's as good a number as any. Who knows what it is in real life? And so they're going to pay $238,000 to the IRS and have $762,000 out of the $1 million left to then turn around and gift to charity, right? So I'm assuming a 37% tax bracket. So the taxes saved for this person, for this very generous business owner, is $281,000 and change based on this $762,000 deduction, which is really nice. But now let's see what would happen if we made the gift before the sale of the business. So everything on the left side of the page stays the same. However, because we haven't sold the business yet, there is no taxable gain. And then when the business eventually gets sold, the charity owns the shares because you made the gift before the sale. And so there's no recognized taxation to the charity because it's a non-taxable entity. So what ends up happening is your gift was actually the full $1 million. The charity got the full $1 million because they didn't have any taxes to pay. And your charitable gift, your charitable deduction is based on the $1 million, not the 762. So you get a deduction for the full $1 million, and your taxes saved is $370,000. So now when you compare the two scenarios, you avoided $238,000 of taxes. You increased your charitable gift by $238,000, not costing you an extra dime, and you got about $88,000 of extra tax savings for planning ahead. So when you put all these numbers together, it's actually pretty incredible. On a $1 million gift, you have $326,000 of extra benefit that goes to you and the charity by making the gift before the sale of the business as opposed to after. So you're leveraging your charitable intentions, which is great for everybody. So this can be a very powerful technique. The tax ramifications of installment notes are important because they are such a common tool in sale transactions. About half the business sales in America include some form of seller financing. With an installment sale, part of your business value is paid out in installments over several years. You're taxed when your payment is received. So by spreading out the payment, you can smooth out your tax spike. It's especially useful if you can stay under certain thresholds. So for example, as a married couple, you only pay 15% capital gains if you stay under roughly $500,000 of AGI. And again, as a married couple, if you stay under $83,000 of AGI, you pay zero capital gains. Now, this may not be realistic for you on the year you sell your business, but what about the second, third, and fourth year when you're in retirement? You can also negotiate a fair rate of interest for the money that you're waiting on to be paid out to you. And you can create a monetized structure if you're worried about counterparty risk and worried that the buyer can ultimately fulfill their obligation. Finally, by not making the buyer pay all up front for the business, you might be able to negotiate a higher price. So you definitely want to do the math, especially if you're going to be close to any capital gains tax thresholds, so you can manage around them. It could be a win-win for you and the buyer. Rolling over equity is a very common strategy, especially with financial buyers. Owners like it because they can diversify part of their net worth while having meaningful upside in their company. Many buyers, especially if you're going to stay on as CEO, want you to have continued skin in the game, so they'll encourage you to roll part of your equity over. What's sometimes overlooked is that you can structure the deal in a way where you can get taxed on your rollover equity or not. So, why would you ever want to get taxed on your rollover equity? Well, let's say I'm planning on an unfavorable move. So I'm a business owner in Texas. I'm going to take semi retirement by moving to California. I may want to pay all my taxes now, get an increased cost basis on my rollover equity, and then not and then have to worry less about California taxes when I'm a California resident. I may just be generally worried about tax rates going up, and I rather pay the devil I know. And then there's other life circumstances that could lead somebody to believe that their tax rates are going to go up, for example, an inheritance. What are the situations where you would want to defer the tax? Well, if you're planning a favorable move, so I'm a Californian business owner and I'm moving to Texas, I would want to defer my taxes to pay as little as possible while I'm a Californian resident. Or there might be some planning opportunities that I'm willing to take into consideration at a later date, but not today. For example, if I'm planning on possibly making a large charitable gift when I'm going to be taking a second bite at the apple, or, for example, qualified opportunity zones. I may be very nervous about real estate prices today, but thinking that maybe real estate will normalize over the next few years. And then I also may be worried about what the firm might do post-sale. So if I think there's a decent chance that the value decreases post the sale of a chunk of my business, I may not want to pay taxes on it now. The bottom line is that avoiding taxes now is not always the optimal strategy. You should discuss this with your team. The old joke in exit planning is that everybody leaves their business. You just get to decide whether you want to go vertically or horizontally. This slide is for the I want to go horizontally crowd. If you pass away with your business inside your estate, your family can get a full step up in basis, meaning that all the gains embedded in your business are just wiped away for your inheritors. Now, in a separate property state, you have to be careful about the ownership of the business. But in community property states, you get a full step up in basis at your spouse's death if you're married, and again at your death or vice versa. If you have good management in place, you can often work other financial arrangements to compensate your management team until your death. And since you're waiting for your demise to transfer your business, you can use life insurance as a tool to help with the transfer. For example, if your executive team will be buying the business from your family, they can use life insurance, which is income tax free. And if you plan ahead, it can also be estate tax free. The allocation of taxes upon sale are complicated, and I am by no means an expert. My intent on bringing this up to you now is to highlight the fact that you and the buyer of your company are at odds. There's an old saying with sale transaction that goes, I'll let you set the price if you let me set the terms. When you sell your company, there are at least 7 ways you can allocate across tax types. With at least 4 of these, you're at odds with the buyer. So you have to demand from your team that this is part of the negotiation up front. It makes no sense to negotiate a price unless you at least have a rough idea of what this means to you in after-tax dollars. So once again, plan ahead. Let's talk about stock versus asset sales. Many of you have heard of them, so what's the opportunity? Well, if you're selling a C-Corp, you rather sell your stock to avoid double taxation. However, the buyer will want an asset sale for 2 major reasons. Number one, they want a step up in basis on your assets so they can start depreciating them right away. And number 2, they don't want to inherit your liabilities. That makes it tough to go for a stock transaction. However, sometimes the seller just absolutely wants a stock sale. Why? Well, maybe the tax difference between a stock and asset sale is huge. Or in some cases, contracts need to be transferred with the legal entity. In those cases, what do? Well, there's a type of election you can make called a 338H10 election that have to be made by both the buyer and seller. What it does is it allows the buyer to treat the transaction as an asset sale and the seller to treat it as a stock sale. It's the best of both worlds. Now, the key here is eligibility. The buyer and seller both have to be corporations, and there are other qualifications such as the percentage of the business that you're selling. And in real life, this still isn't quite as good as a pure asset sale for the seller. But it's definitely something you need to ask your team about if you're selling a corporation to another corporation. This tax reduction strategy is in regards to the liquid wealth generated by the sale of a business. When an owner has a windfall and turns their closely held business into liquid assets, most families will need to have that money managed. Of course, part of the game with liquid investments is to get your fees as low as possible. So wouldn't it be wonderful if you could deduct those investment advisory fees? Before the Tax Cut and Jobs Act, you could take investment fees as a 2% miscellaneous itemized deduction, but now the rule is you cannot deduct investment advisory fees. Enter the lender family office, who got taken to court by the IRS because they were running their family office as a business and therefore argued that as a business, they can deduct asset management expenses. Well, the IRS lost that case, and now it's a template for how to deduct advisory fees. This is not simple, and after some hefty tax and legal bills, it's probably not worth doing unless you're in the 8 figures of liquid assets. But if you're there and you want to jump through the hoops, it's possible to reduce your advisory fees by your marginal tax bracket, or call it 37%. In some cases, that could be millions of dollars for you and your family. So it's definitely worth asking about. Moving on to employ some creative thinking around earnouts. Many business owners stay on for a few years after they sell their business. Most of the time, the ex-owner of the business doesn't need their salary as they just went through a liquidity event and they're flush with cash. When an owner sells and is now getting a salary, 100% of that income, or close to it, is taxed at normal ordinary income tax rates. Now, instead of staying on as an employee, what if you left your firm and just had a consulting contract with them? The tax reduction on the firm side is similar. The big difference is now you're once again a business owner, and this time of a tiny little one-person consulting firm. So what you can do is you can set up a pension for yourself to defer all that compensation by making pre-tax contributions to a pension. There are, of course, limits as to how much you can do, but if you qualify for the maximum, it's over $200,000 a year in 2022. You can also make a contribution for your spouse if they're helping you run the consulting firm. After a few years, when you're done consulting, you can roll that pension into an IRA and slowly take all that income over your retirement. As always, there are hoops to jump through, but this strategy has the potential to defer most of your post-sale income taxes. Last but certainly not least are opportunity zones. One thing a lot of people don't realize is that you can start a business in a qualified opportunity zone and get tax breaks. Secondly, if you have just gone through a transaction, you have 180 days to find an opportunity zone to roll your capital gains into. Now, different entities have different deadlines, so there are various extensions you need to ask about. One benefit of an opportunity zone is you can roll over your capital gains and defer paying those taxes until 2026. That's for the gains you rolled over. But if the opportunity zone investment itself makes you money, you can exclude 100% of the capital gains in that investment as long as you hold it for 10 years. This can mean a mountain of taxes deferred and avoided. In conclusion, start planning years in advance. Strategies like qualified small business stock or moving equity out of your estate need to be planned years in advance. Find yourself a qualified team. How many things have you done in your life where you did them well the first time? Maybe none, or at least very few. You don't want to be your own guinea pig in what is likely to be the biggest transaction of your life. Find people that do this all day, every day. And remember that depending on your situation, you can combine several of these strategies to create what Charlie Munger would call a Lollapalooza. That's all we have for this video. I hope you found it helpful. Thank you so much for watching. If you want to make sure and not miss any of our future videos, please hit that subscribe button. And if you want to help the channel out, please like this video. I appreciate it, and until next time.